Unstoppable Real Estate Investors. I'm Rayanna Starr. I'm your host of the Unstoppable Real Estate Investor podcast. We've been doing this for a couple of years. We're live in my Facebook group, The Unstoppable Real Estate Investor. I invite you all to come join us. We're a growing community. We are a community of friendly, like-minded people that share resources generously with each other. This is one way I do that. My guest today is Liz Lopez. She's an investor, but more importantly, a lender, and she does all kinds of lending. And I met Liz through JJ Azizan in his group. She was speaking, and she was speaking about DSCR loans, debt service coverage ratio loans. And those are loans that are less traditional than a lot of other ways we leverage hard money and private money. And then there's conventional loans. DSCR loans are a whole just species of their own that she's going to be talking to us about. But before we dive into all of that, Liz, why don't you just talk a little bit about your background before you got into loans and real estate.
Yeah, so I was actually bartending on and off for 18 years, just trying to figure out what I was going to do with my life. And a friend of mine was like, I worked with him prior, and he was like, you'd be really good in this business. So 19 years ago, he brought me into the mortgage business. I started as a loan officer back then, before there were licensing requirements. And we were selling those, pick a pay, neg am loans. I was part of that got people in trouble, fortunately. I've been in the business. I have never left. So even in the downturn, I taught myself how to process loans. I got into underwriting. So I was an underwriter for 12 years, a conventional FHA VA underwriter. I have a huge knowledge base from that. After that, I was a branch operations manager with Fairway. And then 2 years later, I became a mortgage broker. So I'm a licensed loan officer, and I specialize in the DSCR loan products.
And do you also do, I lost my comments. Hang on a second here. I went on Facebook Live and then lost us. Let me do that again. Okay, there we are. So do you do conventional lending as well as hard money?
Yes.
And renovation loans and stuff? Awesome. So you went from a bartender, and this guy finds you, plucks you from obscurity and says, hey, you would be good at this.
Well, I was one of his managers at one of the restaurants, so he had worked with me prior, so he knew. I mean, I've always been a hard worker. It's just been in my blood. I've been working since I was 14, and I'm just a dedicated, hardworking person. So yeah, he was like, you'd be really good in this. And so yes, he brought me in, and I'm very happy he did, because I'm extremely happy.
Is it better than slinging drinks for a living?
That was fun. Brought out the extroverted side of me. And, I always enjoyed that. But yeah, absolutely much better. I mean, I work from home. I make my own hours. I'm my own boss. It's way, way better.
We share a similar history. I put myself through college bartending, and I really loved it. I thought it was fun. I loved making the drinks. I loved socializing with the people. It was a fun job. Yeah. So then you transition into loans, and how was that transition for you? Because that's a really different work environment to go from tending bar to, oh shit, I've got to get my license.
We weren't licensed back then, so there were no licensing requirements back in 2005.
Oh, okay.
Yeah, anybody could be a loan officer back then. And how was it? I mean, it was definitely challenging. Your first few years in this business are extremely challenging. You have to have thick skin, or you're not going to make it. And, you got to be able to survive when rates are high, like right now.
Now, do you have to have in some states, you're required to have a real estate license in order to be a loan officer? Did they grandfather people in who were already loan officers?
So now, after the SAFE Act passed in 2008, 9, 10, people have to be licensed now. So you do have to be a licensed originator. However, the DSCR loan product is a little bit different, because not all lenders require a license. There are certain states that require a license, and certain lenders that require a license to sell the DSCR loan product, to originate it.
And you dotted those I's and crossed those
Yes,
T's?
yeah. So yes, I'm licensed loan officer. I'm licensed in I think 9 states now. But I only get licenses if I have to, if I need to.
In order to do loans in a particular state.
Correct. Because I'm able
How
to
many
do
states are
these
you
nationwide.
licensed in?
What, I'm sorry?
How many states are you licensed in?
I'm licensed in 9 states.
Right on. All right, list the 9 states slowly. Everybody take notes. Notice if you're
But
investing in one of
well, the
these
DSCR though, I
states.
can do nationwide.
Oh, all right. But what about other lending products like hard money, renovation
Hard
loan?
money, I can do those nationwide also. It just those are
Oh,
gonna
it's
be
just
lenders.
conventional lending.
Yes, yeah, just government and
Okay.
conventional that I would really. So there are certain DSCR lenders that do require license, and there are certain states that require license, but majority of them don't, and majority of states don't.
Okay. So, what is it about lending that you like? What, like bartending, it brought out the extroverted side in you. Are you an ambivert, a little introvert, a little extrovert?
Yeah, I actually
Yeah,
just
I
took
am too. Yeah.
the Myers-Briggs, and it showed that I was 71% extroverted and 29% introverted.
Are you an ENFJ or an ENFP?
ESTJA. I am a executive ESTJA.
Wait, say it again, the
I'm
letter.
an executive ESTJA.
Oh, okay. Yeah, I'm an ENFJ.
Okay. Okay.
Okay. Yeah. So, talk about like the transition into being a loan officer, the learning curve. And then I'd like to hear what loans you like the most and why. So talk just about that transition first.
Yeah, I mean, like I
Just
stated, the
learning the
first
business.
2 years
Yeah.
are extremely challenging in this business. My being an underwriter and the 12 years of underwriting gave me huge knowledge base because I often get conditions waived on my loans because the underwriters put feel good conditions on loans all the time. So I mean, the transition, it's there's a lot to learn, and I'm still learning in this business, and I've been in it 19 years. You're always learning something new in this business. Guidelines are always changing,
Yeah.
and that's one thing,
You have to stay on top of it. Yeah.
correct. Yeah. So I mean, this is my favorite loan product to originate. DSCR is not a cookie cutter loan. Every DSCR lender has a different set of guidelines. So it's not like a conventional loan. You can go, to Chase or Wells Fargo or Quicken. You're pretty much going to get underwritten the same and have the same set of guidelines. Not the same with DSCR.
Okay. So is that the main reason you like it? Because you can
I like it because
customize?
it's intricate, and there's not a lot of loan officers who specify in this loan product. And I mean, with my underwriting background and guidelines, they come easy to me. It's easy for me to remember them. But I do have an Excel spreadsheet with 65 of my lenders on there, all different tabs with all their different loan amount, minimum loan amount, minimum FICO. Do they do short-term rentals? Do they take appraisal transfers, layered entities? I mean, anything
Wow,
you
so
can
you
think
have a
of.
lot of resources, a lot of lenders to choose from. That
Yes.
gives you a lot of flexibility.
Correct. Exactly. So I mean, my client calls are, my first call, a client is 30 to 60 minutes, and I'm finding out a lot about them, but I'm also diving into what their loan and
Yeah, we had that call.
yeah, yep. We did have that call.
Yeah, and the first step for me was, all right, first I'm going to do a HELOC and do a little more house hacking and do a renovation. And then when I'm ready to go buy another rental, then it's like, okay, I got my 20% down, let's go. Because isn't that one of, and Jerry, one of my clients, wants to connect with you. So,
Okay.
you know, look at the screen, guys. Look at the Zoom screen. And Rose, write this down. Liz, it's okay to give them your phone number, right?
Absolutely. My
Yeah.
phone number's all over the
So
internet.
Liz is very good at communication. She and I connected right after JJ's that night. And we were talking the next day, and within a couple of days, we had our appointment, and she followed through. She does what she says she's going to do. She sent me an email. There was a link in it. I was approved for 75,000 of a HELOC, like in less than 5 minutes, and
Yeah,
boom, it was
amazing. You know,
easy.
speed, communication, and accuracy are how I pride to live my business. I live my life that way, and yeah, I'm just
Yeah, so
go get 'em.
Rose, my assistant, Rose, write her phone number down. It's Liz Lopez, and she's in Arizona. Arizona, right?
Correct. Yep.
Yeah. 602. Everyone write this down, because this is about to open you up to a whole new world. If you've been doing all your deals with hard money and private money or your own money, you need to pay attention to what we're about to talk about. Okay, Rose beat me to it. She already got there. My Rose, I just love Rose. I'll
Amazing.
tell you, if you do not have a virtual assistant who is your arms and your legs, then come to me, because Rose and Martin, her husband, I just referred them to 2 or 3 of my clients. They're fabulous. Between the two of them, they can do anything for you. But Rose thinks for me now. Half the stuff, I mean,
I have an assistant, and she's just like that. I would not be able to have this many loans. I have like 35
yeah, and it
active loans
frees
now.
you up to be doing what you're
Absolutely.
good at,
100%.
what you like to do, and then they take care of everything else. So, mwah, to my Rose. Love you, Rose. Okay. So Jerry, write down Liz's number, 602-410-0995, and call her. Jerry's a client of mine. He has half a dozen rentals. He lives in Wilmington. He's got some in Asheville, and he's doing some wholesaling, but he wants to also grow his rental base. So you could help him with that. And he's an experienced investor, very
the best thing about this loan product is that there's no job and no income requirements. So I mean, you can be retired and get into this loan. It's strictly based off the cash flow of the property.
Yeah. So talk about DSCR, means debt service coverage ratio loan. Talk about what that means, because it's perfect right after what you just said.
Yeah. So for an example, say your rental income is 1,000 and your mortgage payment all in, meaning principal, interest, taxes, insurance, if there's an HOA, if there's flood. So your full mortgage payment is also 1,000. That would be a 1-to-1 ratio. Most lenders, DSCR, would like to see a 1 ratio. Some of them want to see like a 1.15, some a 1.25. I have lenders though that will do a no ratio or a low ratio loan. So if it doesn't cash flow, I can still get you a loan. Remember, lenders.
Wow, that's weird, because it's a debt service coverage ratio. If you think about that, the fundamentals, say the fundamental principle of this, what that means.
Well, even if it doesn't cash flow, I mean, the lender's gonna hedge their risk somehow. So it's gonna be a lower loan to value, higher interest rate. And I mean, that might be a circumstance where somebody is buying a property, they're going to, maybe make some improvements, add value to increase the rental income. So eventually it's going to cash flow. But right now they're okay taking a little bit of a hit on the LTV, higher interest rate, just to get into the property.
Yeah, and that loan to value is important, because that's what this whole loan is based on, is that ratio that the debt is serviced, covered, the debt is covered by the rent, by the income of the property. So for those of you who are wanting to build rental portfolios and you think you need hard money and private money or your own money, this is a wonderful opportunity. And what's so great about it is not dependent on your credit or your income.
It is dependent on credit.
Okay, so credit comes into it.
All these loans, correct.
Okay, so credit comes into it, but not income. So those of you who are self-employed, you don't have to worry about 2 years of income tax returns and them opening, having to have 3 months access to bank statements.
I'm not going to ask you for any income. Another thing is that these are long-term loans. They're 30-year fixed, predominantly principal interest loans. I do have 40-year AMs. I have interest only. I have ARMs, but I would say 99% of my investors choose the 30-year fixed P&Is.
I love it. All right, so what do you want to say about these loans, things to look for, in lenders, good ratios, give examples with clients you've worked with? Make this real for people, Liz.
Yeah, but I mean, I have predominantly lenders are going to want to see, 680 FICO or over, but I have lenders that go down. I have one that goes down to a 575. I have a few that go down to 620.
You're talking about credit scores.
Right, correct, credit score. And then as minimum loan amounts, a lot of these DSCR lenders, have 100,000 minimum loan amount. I do have one with no minimum loan amount. I have a couple that are a few at 75. I've got one at 50,000. Some lenders will do short-term rental income on these properties. Predominantly, we want to look at these properties from a long-term rents perspective. Do they cash flow with long-term rents? If not, is it a good short-term rental? On a purchase, we will pull the AirDNA. There's the paid version of AirDNA. There's a button on there that says projected income. So on a purchase, that's what the lender's going to go off of to see if it will qualify for short-term rental. Now, just because the income on and the occupancy is okay on there, we still have to make sure that we have comparable properties. That's one thing with those unique short-term rentals. We have to have within a couple miles comparable properties. I've run into a few times the issues with not having comparable properties, and then we have the lenders will drop the
And
value.
our comps with short-term rentals have a wider radius than the usual quarter or half a mile.
I mean, it's usually about 2 miles, but there's no specific range.
Well, that's a big radius for comps, because usually when you're buying or selling, you're looking at a quarter to half mile radius. And so that's good to know. And that's short term, but would you say that DSCR loans are mainly geared towards long-term rentals?
Mainly, but
Yeah.
yes, mainly yes. We'd like to look at it that way first. When you look at it from short-term rental perspective, a lot of the lenders will limit the LTV by 5%. So if we can do it long-term, you're going to get the most benefits that way.
And what would you say, like, for someone to qualify for most of your lenders for this type of loan, what would you say on average the purchase price should be that they're looking around? At least 100, at least 300? You said some of them only do several 100,000. So what would you say is a good price point?
I mean, I would say probably about, your 200,000 is probably about where you're going to cash flow. If it's a duplex, definitely going to cash flow. But on the short-term rentals, I've gotten many short-term rentals done that are, 700,000-800,000 purchases, even $1 million purchases, because they're great short-term rentals.
And so is there an upper limit on what you can loan to for DSCR loans?
I mean, certain lenders do have maximum loan amounts, yes.
Yeah, and they have minimums. What would you say
Correct.
the minimum is?
Majority of them have 100,000 minimum, but there's other ones at 125. There's some at 150, some at 200. But then, like I said,
Almost similar to being an accredited investor in, say, a syndication. Usually the base is 100K to get in. You have to have at least $1 million in assets.
But I have one with no minimum loan amount. I'm sitting in their building right now.
All right, I love that. Love that. Yeah.
They have great interest rates on their DSCR loans. Now they are pretty stringent the way that they condition like a full doc loan. They're very stringent, but they have the DSCR product, and I've used them many times.
Who's your ideal loan candidate?
My ideal, like if I had a borrower coming to me, who would be my ideal candidate?
Yeah, like if I waved a magic wand and I was saying, who's your ideal real estate investor candidate? Like ideal temperament, what they're looking for, their credit score, what would you say is
for best pricing over a 780 FICO? They're going to get the best pricing. Having the funds in your bank, season and source for 60 days makes it easy. Then there's no large deposits. Some of the lenders will want to source and season large deposits. I have one lender that doesn't. As long as the money's in the bank, that's all they care about. I've got another lender that's at 10 days. So they're going to do a 10-day look back to see if there's any large deposits and then question them. So a borrower that has the money sitting in the bank for 60 days, a higher credit score, it cash flows. So we have the DSCR ratio, at least a 1. I would say, but we can be over one, because you don't want to be at a one submitting the loan into underwriting, because it could always go down under the run. So if you got a 1.25, that would probably be ideal candidate, ideal borrower.
The ratio. And by the way, anyone who would like to jump on and ask Liz questions or be part of this conversation, please do. But I will not admit anyone on the Zoom that does not have their name, their full name identified. Someone just tried to enter with iPhone. I had a very bad experience a few weeks ago. It was humiliating. Someone jumped on, and then all of a sudden there was this porn flashing on the
Oh my
screen.
goodness.
It was like, oh my God. And so I'm very picky about, you have to identify yourself. You have to notate who you are, or I will not be accepting you in the Zoom. But please, Rose, please include the zinc, the link, the zinc. I'm trying to put Zoom and link all together. It's called Zinc. Put the Zinc, the Zoom link, Rose,
Hey,
to our meeting today. So
patent that
anybody
up.
who's watching, because we've got a lot of people on today, please feel free to join us if you have questions. I know Sevelin's there. She's a lender, more of a private money lender, and she coaches people on that. We've got Carl Limback, Richard Yasmin Romero. We have Nanette, Jerry's on here. Lance Riggin,
Oh, I wish I could see everybody.
Herbert, Lacey, John, please, Maranta Nunez, Cassandra Johnson, J.U., Pansy Sleep, and a couple of others. Please feel free to jump on the Zoom and join us and be part of the conversation, and feel free to ask Liz questions. So back up a little. So you would say the minimum, so the ratio, talk about that a little more, like debt service coverage ratio. Talk about the minimum ideally needs to be that the debt is serviced by the coverage of the rent you're making. So if you're paying $1,000 a month mortgage, a 1-to-1 ratio would mean you're just breaking even on that property. You're charging $1,000. Well, we're not buying rentals to do that. So usually, ideally, we're looking for a 1.25, 1.5, 1 or above that 1-to-1. But at minimum, and you said there's even some lenders that'll say even if someone's taking a loss on their rental, we'll still, but ideally that 1-to-1. But where would you like to see it? Where do you see people are the most successful in that ratio?
1.25, and above, absolutely. But I mean, you asked for the ideal client. I mean, to me, it doesn't really matter what their score is or their situation. Ideal client is somebody who, gets back to me when I ask them questions, and I love talking to all people. So any client's an ideal client.
Yeah, if you're gonna work with a lender, everybody, please listen to me right now. Whether it's a conventional lender because you're buying a house for yourself, or you're working with someone like Liz who's just got an expansive array. She's not just conventional. She's also on the investor side of things and can pretty much drum up any loan you need. Understand this. They're going to go into your panty drawer and your sock drawer and your junk drawer. They need information from you, and you need to cooperate. You need to, it's personal, and they're going to want to know. Now, they don't need bank statements for a DSCR loan. That's what's so great about it. But they are going to need your credit. And
we do need bank statements.
You do need?
You have to, well, you're going to need on a purchase, you're going to have 20% down.
Oh, yeah.
You need to see where the money's coming from. Now, on a refinance, keep in mind that all of these loans have reserves. Just like a regular conventional investment property, you're going to have reserves. Some lenders are 3 months, some are 6 months. But on refinance, a lot of these lenders will allow you to use cash out proceeds for the reserves. So you actually don't have to provide your bank statements if you're using one of those lenders.
Okay. So the thing that Liz is saying, like, I responded very quickly. She responded very quickly. Within a day or two, I had approval for a HELOC, which is where I was going to start because I wanted to do a renovation on my own home to add a unit and then also pull enough money out, because with a DSCR loan, most of them you need a 20% down, right?
Yeah, I've got two lenders that are at 15%, but I mean, the rate's about 2% higher. Last time I priced them, the rate was in the 10%. So you don't mind having a higher rate, you just want to bring it 50% down.
And right now with the market the way it is, what's the average interest rate for a DSCR loan?
Well, I mean, that's a loaded question, but I mean, they're very driven by the credit score. So, over 780 credit, I'm pricing them in the high sevens.
Okay. And what if you're in the mid sevens?
Eights.
8. And what if you're under 7?
Nines.
Okay.
9 to 10%, just depending on where it's at.
Okay.
But
All right.
property type, manufactured home, we're limited at 65% LTV. You're definitely going to have higher interest rate on that. So yeah,
Now,
you could do this loan product on single families, manufactured homes, 1 to 4 units. I have a multifamily 5 to unlimited unit lender.
that'll do DSCR on
Correct. Unlimited
multifamily.
units. Yeah.
So you could do it on single family, multifamily, but what about mobile homes?
Yeah, manufactured homes, as long as they're tied down to the
Manufactured.
ground and they're after 1976 and they're permanently fixed. I have one lender that'll do manufactured homes on DSCR.
So would a tiny house that's been pulled off the trailer and the wheels and put on a strong a permanent foundation count as a manufactured home?
Is it built after 1976? And it's
Yeah. Tiny house.
I don't know. I'd have to check in and see. I have a tiny house lender. I have a chattel lender, tiny house lender. I don't know if those would qualify with that lender, with my DSCR manufactured home lender.
Okay, but you do have a tiny house lender too.
I do have a tiny house lender, correct.
Okay,
Yep.
yeah, we need to talk. Okay.
Okay.
So guys, if you have questions about debt service coverage ratio loans, which is what we're talking about right now, please put them in the comments or jump on the Zoom with us and come and ask Liz and get your questions answered.
Yeah, come and ask me questions. I wanted to mention, because you were talking about diving into somebody's history on these loans, and
yes, please.
I would say that the DSCR is definitely less because there's no income requirements. I mean, and on a regular conventional loan, as me as a former underwriter, when you're looking at a bank statement, we're looking at everything in that bank statement. What are their recurring debts? Because it's a DTI, debt to income ratio driven loan. These are not debt to income driven loans. Underwriters not looking for all those little things in your bank statements. So it's definitely less invasive than, a conventional or government loan.
Yeah, and thanks for saying that, because I lost my train of thought. So I want to come back to that. Is when you're working with a lender, be cooperative, get them the information they need as quickly as possible, because these kinds of loans, just like a HELOC, they're not like a conventional loan. The approval can happen very quickly. Okay. And so you want to cooperate and provide the information Liz is asking for as quickly as possible. So because it needs to go through underwriting, they need to go through the steps to dot the I's and cross the T's. Anything you want to say about that, Liz?
Yeah, I was just going to say, it is a typical process like a conventional loan. It's going to be about 30 days. I would say give me 30 days. I've gotten many purchases done in 2 weeks, but I would say give me about 30 days.
Okay.
It's the same, we get a loan application, we do a credit pull, we gather documentation from you, we send you over to the lender. So just like you're going to Chase or Wells Fargo to an underwriter, you're going to a lender, you're going to an underwriter. Time frame 2 to 3 days to get into underwriting, get an approval.
See, this is why she's the expert on here, because I keep giving you wrong information and then she's correcting me. So I'm learning from this. Okay. So what other kinds, anything else you want to say about debt service coverage ratio loans, DSCR loans, and who they're good for?
I mean, they're good for anybody who wants to buy a rental property. You don't have to be an investor, But anybody who buys a rental property is an investor. So they're good for first.
And
I have first-time home buyers and first-time investor lenders. So if you've never had a rental before, you can still get this type of loan. If you've never bought a property before, you can still get into this type of loan.
yeah, and it is for rentals, so you can't live
Correct.
in the property. And it's kind of the opposite of Fannie. It's kind of, well, it's kind of the opposite of Fannie Mae, where Fannie Mae, you have to live in the property for a year, or VA, you have to live in the property for a year or two.
Government, right? Government
Yeah.
are the primary resident
Yeah.
loans.
So what else? What are other things do you want to say about DSCR? And then let's talk about some of the other loan products you do for investors specifically.
What else do I want to say about DSCR? I mean, it's just a great loan product. The interest rates may be a half a point higher than if you're doing a full doc loan. So my investors don't care about that. They'd rather just not have to provide all their income to
Well, all that cost gets absorbed into the rent anyway. So
right.
yeah.
You're running right. As long as you're cash flowing, that's what they care about. Something to be aware of with these loans is that they are normally priced with a prepayment penalty.
Okay.
I have
what is it, 3 to 5 years?
normally, yeah, but you can normally buy it. Definitely you can buy it down, and then with some lenders you can buy it outright. So if you absolutely don't want to have a prepay, with some of the lenders you don't have to have a prepay, but you can always buy it down. So a lot of my investors right now, I'm pricing them at like a 1-year prepay unless they don't care, because interest rates, a high rate environment. Eventually they're probably going to want to refinance out of it. So that's definitely something you want to be aware of with these loans. What else?
All right, explain that in layman terms. Prepayment penalty, what that means to newer investors here.
Yeah.
Buying it down, talk in layman terms so the newer investors know what you mean.
Yeah, so that means if you refinance or if you sell the house within a certain period of time, you will be assessed a penalty. The prepayment penalties are either going to be a fixed or a step down. So they're either going to be a fixed amount of your principal balance that you'll have to pay, or it'll be a step down. Like the first year will be a certain percentage, second year will be 2%, third year will be 1%. It's usually like 80% of the principal balance. But every lender
what's the longest prepayment penalty?
5 years.
Okay. So and usually they average 3 to 5 years in that range somewhere, right? Once you get past that prepayment penalty, if you want to refinance or you want to sell, you don't have to worry about it. So it is something to keep in mind, especially with higher interest rates right now. But really that doesn't have to be an issue, because if you think about it right now, if you're buying investment properties with something like this, that is a long-term loan, unlike a lot of hard money and private money, it's really a mortgage. You're building the cost of that interest into the rental payment. So you hang in there for 5 years. And then if interest rates, I doubt they're ever going to get as low as 1.75 again, which I think is as low as we went. But they could get down into the 3s and 4s again. So you could always refinance. That's probably not going to happen anytime soon. So you're golden. Yeah. Anybody have any questions? Go ahead.
I was going to say, so you can close in an LLC in these loans or as an individual. So that's something different. Conventional loan product, you cannot close in an LLC. So investors do like that. However, we are still pulling your credit and you are still personally guaranteeing these loans. There's a misconception out there in the community that there's no credit required on these loans. I would say half at least my lenders report to your personal credit report. So if that's a big thing for you guys, and it is for some of my investors, you want to make sure your loan officer is sending you to the right lender that's not going to report to your credit report.
Yeah, the only difference between qualifying for this loan and others is you're not having to qualify based on income. You do have to have a credit score, and the property is qualifying for the income.
Correct. Yeah, and then something I run into with a lot of my investors, especially those in the sub-2 community, the Pace Morby sub-2 community. So they teach us, I'm in that community, they teach us to have a holding company and then have your LLCs under the holding company. That is a nested or a layered entity. A lot of these lenders, some of them won't allow that. So definitely make sure, like I said, once again, your loan officer needs to do their due diligence up front, ask the right questions, and making sure that they're sending you to the right lender.
Yeah, and talk a little bit about I know you have a lender, so maybe you don't know the details, but there's several of us that are interested in creating micro communities, tiny house villages, more intentional communities, affordable living. Pansy Sleep's one of them, me, Jerry Goldby and I have talked about this, some others. Um, the research I've done, which I've done quite a bit of research on different kinds of buildings, tiny houses, prefabs, modulars, container homes. I have a couple questions for you here. What I've researched is tiny houses, traditional lenders don't loan on tiny houses. When tiny house companies have lenders, they are personal loans. They aren't traditional mortgage loans. So the interest rate is really much higher. If you're worried about 8 or 9 or 10%, these are like 20%. And you don't think that's much, but I took a personal loan out to buy a piece of land a couple of years ago at 20%, 19.99 APR. And if I were going to take that to the term, which I'm not, a 5-year term, I'm getting paid off in less than 2 years. I was going to pay $11,000 in interest on a $20,000 loan, and it's supposedly only 19.99% annual percentage rate. So personal loans, they're way more expensive than traditional, conventional or real estate loans because it's an APR. It's not, you know, uh, over the, it's just, it's, it's a lot more, right? Can you explain that? Because I'm not good with the numbers and explaining that.
So I am not an expert in tiny homes. I have a referral lender. So I don't actually do tiny homes. I send you to this, it's a chattel lender, so personal property chattel lender who will do those loans. So I am definitely not one of
Okay, same as loaning for manufactured homes.
Yep.
Yeah. Okay, got it. And then what kind of other loans do you do particular to investors? Construction, rehab, talk
Yeah, a
about all
lot of
that.
let me touch on one little thing with the
Sure.
DSCR. So we can do them on rural properties, foreign nationals, manufactured homes, like I said before, and then the larger multi-units. So I just want to touch on that piece. As far as other loans for investors, we have bridge loans, which are they're just hard money, short-term financing type of loans, renovation loans. Uh, I have a lot of hard money renovation lenders. I
Let
have
me ask you this. Go back to DSCR. Can you convert? Like, if someone wants to buy land and they don't have proof of income yet because they're going to develop the land, they would start with a construction loan, right?
Mhm. Yep.
Can that be converted into a DSCR loan?
It's going to be another close. There's no like just straight conversion. There are fixed to rent lenders, but it's still 2 closings.
Well,
However,
yeah, I would assume that, but would that be a good way to go, or would you just convert your construction loan or rehab loan into just a traditional mortgage? What's the better way to go?
I mean, it's up to you. Do you want to provide all your income and get into an investment property
There
loan,
it is.
full doc,
Okay.
or do you want to do a DSCR with no income? Do you care
Okay,
if the
got
top is
it.
higher? That's really the only difference.
But all loans, all of them require a credit score.
Yes.
Now,
I have, so to answer that a little bit, hard money lenders, there are some that don't require a credit pull. All DSCR lenders will, but there are some hard money, short-term bridge loan financing lenders that do not require a credit pull.
okay. So any questions? I'm in a room at my co-working space and someone has it at 1. So we've got 3 minutes, Liz. So I want to ask you, is there, who's your ideal client? Who do you enjoy working with? Like,
Anybody.
who do you like helping?
Anybody. Investors. Investors are my ideal client. I thoroughly enjoy working with investors. I work with
As opposed to first-time buyers who are
regular home buyers. Yeah,
clueless?
I mean, investors speak my language. They know my language.
Okay,
It's not their first rodeo. You know, I don't have to explain things over and over and over to them.
okay.
And they have 20, 30, 40, 50, 60 properties. So, you know, if I do a good job, my assistant and I, they're coming back to me and we're going to have a long-term relationship. And,
I love
you
that.
know, I'm always available. I am on the phone a lot, but I'm available. So if you have questions, text me. I will
Yeah,
always.
I can attest to that.
It's just one
And then
thing.
here's the last question. Yeah, go ahead.
I was just gonna say, it bothers me in this business. It's easy to shine because people don't communicate well. They don't answer their
Yeah.
phone. They don't get back to people. I mean,
Right.
it's easy to shine in this business.
That is so true because I have called lenders and I'm still waiting for a call back. And that was like a year ago. Same
Yeah.
thing with realtors. It's
And
like
that's why they're starving and I'm not.
Maya Angelou, when people show you who they are, believe them the first time. All right, so last question, and then we've got to wrap up because someone needs this room. Rooftop message. If you were to jump up on a rooftop and had a captive audience that was hanging on your every word, what would your advice be? And we're talking about real estate investors.
Hang on, because it's a rough ride. When it comes to mortgages, I mean, they're not all just smooth, easy going. You know, there's always things that happen that we can't foresee, and it's just a part of this business. It just comes along with the territory. You know, most of the times when these loans get declined, it's due to collateral. It's something that we have no control over it. You know, so but real estate in general, you know, I'm an investor myself. I've fixed and flipped homes, had some long-term buying holds. I have a short-term rental. It's just a tough business. You got to have thick skin. You're going to make mistakes, and those failures are going to propel you forward and make you better in the future.
I freaking love that. That's how we're aligned. You've got to be resilient, persevere, bounce back quickly, never give up. Love it. Thank you so much, Liz. This was action-packed, full of content. I'll be in touch because I'm going to be moving forward with some things with you. Guys, contact Liz. Her phone number's posted in the comments. It's also on the screen here. If you look, 602-410-0995. She's excellent at communication and she's very responsive. Thank you.
I love this. Thanks for having me on.
Yeah. Take action. No excuses. Get results. Bye now.
Have a great day, everybody.